We are with Fabio Campanella. There can't be a more Italian name. Now, when you say that name, there cannot be Fabio Campanella.
There can be. You have to say my middle name.
What is it?
Domenico.
Fabio Domenico Campanella. Whoa.
There you go. I came here with a pizza and a plate of pasta.
Did you?
And you made me an espresso.
Yeah, double espresso that's already gone.
Yeah.
You needed it.
Yeah.
So what's going on? Why did you put together this book? What are you doing?
Okay, so I put together this book. I actually started a much larger book, right? So
do you understand how difficult it is to write a book?
I do now. Okay, so I thought maybe I knew something about writing. In the past, a couple dozen times, I've written columns, let's say for the Globe and Mail.
I forgot, because I would get them from Financial Post, I feel like.
Exactly. So like Financial Post, Globe and Mail, Toronto Star, and other like smaller publications.
I was the anonymous guy commenting, just saying, what, this is fucking bullshit. Who is this guy?
Son of a bitch. But anyways, so I'm like, oh yeah, I think I know a thing or two about writing, because this was like pre-Chat GPT days, right? Mm-hmm. So I actually had to write these things, right? And I had to really I actually quite enjoyed the process, because this stuff is going out to the public, presumably quite a few people.
Yeah.
And I better be right. I better not make a mistake. So I really enjoyed the process of writing, especially technical writing for the masses, not technical writing like in an academic sense. You know what I mean?
Do you feel like you got a deeper understanding of the material?
I do, because I force myself to understand it really, really well in order to publish it, right? So I said, okay, I've done a couple of...
Does anyone screen those things when you write for those?
They don't screen anything.
Okay, that's
they
what I thought.
Take
they
it
just take
at
it and put it in the paper.
Value,
and then you can just say, I was in the Financial Post or the Globe and Mail or whatever newspaper.
I could tell you anything. They just trust. They're like, oh yeah, this guy's a CPA or CFP, whatever. It's good. They don't screen anything. They don't have time, nor do they have the money.
I think you get to a certain age in life when you realize, and maybe you've just dealt with enough lawyers and accountants and different professionals, you're like, holy shit, there's no definitive yes or no on anything. Everyone just has an opinion.
Nobody knows what they're talking about.
Knows exactly.
Nobody knows
what they're talking about. So when you discover that, you have a competitive advantage, because you can say to yourself, I can accomplish anything I want.
Pretty much. As long as you sound convincing.
Yeah, the conviction in your voice,
right?
Key to sales, yes.
Yeah.
Go.
So anyways, I enjoyed the writing process. I said, and it was actually you that said, Fab, you got to write a book. And I said, okay, sure. So I started out with this huge book about, financial planning for, let's say, the middle class to wealthy, not the ultra wealthy, but, the regular person. And it turned out that, I was like 150, 200 pages deep into writing this book, and I wasn't even a quarter of the way through. And I'm like, okay, well, nobody's going to read this shit. It's going to be 1,000 pages long. And, if I'm lucky, my mom will read it. Right. So there was one chapter in the book specifically on estate transfers and strategies utilizing a whole life insurance policy. And I said, you know what, maybe for my first book, I want to do something short, to the point, and more specialized. So I stripped out that part of the book, the larger book, and I decided to write one smaller book. And, it turns out that writing a short book is actually really difficult as well, because you want to keep this thing,
concise, and it's hard to get all the details and enough details, and there's always nuance on every single subject, and everyone's situation is slightly different. So yeah, it's difficult. And then people judge you on the book, like, why didn't Fabio say this, and why did he miss that? He doesn't really know his stuff, and I don't, it's tough. It is tough.
Exactly. Well, at the end of the day, what I wanted was about a 100-page book. Something that somebody can easily read on, a Sunday afternoon when they got 3.5 hours of free time, let's say. Okay. The idea, though, is I wanted to display how this product, a whole life insurance policy, specifically in Canada, can be utilized to solve a number of different problems that people will have as they go through their journey of wealth. All right. I wanted to show that it's a very versatile option, a very versatile financial product. But I also wanted to show the flip side. It's not for everyone. And there's no one size fits all when it comes to this particular product. And I want people to really understand the basics of the financial product when they read the book and say, hey, listen, this is either for me or it's not for me.
Why is this so important to you, this particular subject?
That's a good question. Okay. And you got a couple minutes?
Yeah.
Okay. So when I was 19 years old, my favorite uncle, Zio Mike, okay, he was diagnosed.
Really Mike, or was that his Canadian?
Michele,
Okay.
yeah. He was diagnosed with cancer, and he was in his early 40s. And I loved this guy. My brother loved this guy. We just loved him. Cool. He was just a freaking fun and funny guy, not a care in the world. And he had 4 little kids. All right. He, gave it his best shot, but he died. And it was
what age?
He was maybe 43, 44. He was a young man. Yeah. Okay. And he was the typical Italian immigrant at that time. He didn't have life insurance. He didn't have a that
would be like rocket science. Yeah.
Yeah. He said, come on, he paid his house off in cash.
Mm-hmm. Makes sense. Yeah, for sure.
In Woodbridge.
Yep.
Right.
Yeah.
But, there was no estate plan. Right. And I remember at that young age, I was 19, his wife and children, they suffered in a sense. There was a lot of good that they had, but they did suffer. Right. Fast forward 20 years later, when I was 39 years old, and I got a phone call from my brother, who was 36 at the time, pretty much the worst phone call you could ever ask for in life. He called me up, and he, at age 36 with 2 little kids, was diagnosed with terminal stage 4 cancer. And what are you going to do? Right? He gave it his best shot, but 4 years later, he succumbed to it. All right. The difference between my uncle and my brother was that my brother learned from my uncle's mistakes. And I'm not putting my uncle down. Once again, he was my my favorite guy in the world. Yeah, okay. Yeah. And it just wasn't part of his culture to do
different era. Yeah.
But what happened during that time was I got forced into a crash course on estate planning. Now, I've been doing this since 2002.
Is that why? Because you have one of the deepest understandings of estate planning for someone your age that we've ever met. So I didn't realize that all these backstories and your life experiences have contributed to all of that.
Well, that's what really triggered me to refocus on estate planning. Now, estate planning, when I was studying tax originally and finance and financial planning, I've been doing this since 2002. It was actually my favorite subject. The thing is, when you're in your 20s and 30s, who's going to...
It's kind of weird for that to be your favorite topic.
Exactly.
Yeah. Everyone's trying to buy a house or save up or,
But now that I'm in my 40s, pushing 50, you're starting to get clients that are within 10 years of your age and maybe even older. And estate planning becomes a huge area of consultation for me. So that's sort of the backstory on why I'm so interested in life insurance products, and estate planning, right? And one of the reasons that I decided to write this book. The reason, the second reason is anecdotally, as I'm dealing with hundreds and hundreds of people every year, new people as well. Like I meet new people all the time, at least 2 or 3 new client inquiries a week, right? I noticed that it's a huge weakness. That these people simply don't have estate plans at all. Right? So if you are a Canadian who has any level of wealth and you care about what happens to your stuff when you die, and you care about other people, to the point where you would want to make sure that they're taken care of after you die, you need an estate plan of some sort. And quite often that estate plan is going to involve some sort of an insurance product. The problem that I see in the industry is that, from a marketing perspective, it's very nice to market yourself as an estate planner. But the reality is it's more along the lines of same thing as like a financial planner. You're really a mutual fund salesperson or a life insurance salesperson. So in the life insurance industry, what I'm seeing, is people are utilizing the product and attempting to fit the product into the potential client's situation rather than the other way around. Rather than looking at the client from a bird's eye view and saying, you know what, does life insurance and life insurance type product work for this particular client? Or will a trust work instead? Or will changing the ownership structure of assets, so on and so forth, rather than starting from the point of the product? It's not about placing a product, at least to me. It's about finding the right solution for the client in the first place.
You're taking the consultative approach.
That's I at least I'm hoping that's what I'm doing.
I've seen you in action.
Right? That's what I hope I'm doing. Right. So this book will it dives into the major problems that you will inevitably encounter as a Canadian who is on a journey to any type of work.
Okay, so I'm going to ask you this. I just want to back up with two questions. What is the minimum where you think someone needs some sort of estate planning? Is it that they have dependents or they bought their first home? Is there like a minimum that you're like, okay, listen, you need to take this a bit more seriously than in the past? If you didn't have any sort of estate plan, you didn't have a will, and you didn't have some of these documents set up, now you have to. Is there a line where people cross where you're like, hey, listen, it's now time?
There's two, basically. Okay. One, you have something to lose. All right, like you have something.
So even if it's not a house, you've started a business, or you have something that is of some value.
Yeah, or you have a job, meaning that you have future income that could be lost.
Oh, got it. Yeah, never thought about it that way.
So you have something to lose. That's number one.
Okay, but a job if you have no dependents.
Well, that's where we get to number two.
Oh, sorry, cutting you off.
Yeah, no. You have something to lose. And B, you care about what happens after you die. You have somebody that you care about, or something, a cause, right? So there are many, many people out there that do not have children. I would say probably up to 15% of the clients that I do very large insurance policies for have no children.
Oh, wow, really?
Oh, yeah. And one of the reasons is they're like, hey, listen, eventually when I die, I care about the church. I care about this charity,
yeah.
Or I care about, the university that I went to, whatever it is. Yeah. And so there's
wow.
There's something that they care about, that they want money to go to, right? So it's not just about people with children and grandchildren and whatnot. Usually that's what the situation is, but there are uses for these products, even if you do not have children or grandchildren.
Okay, so then now what are some of the problems that you cover in the book that people are going to encounter when they go down this path?
Right. So the first, foremost, most obvious one is taxation, right? The more money you make, the more tax you're going to get hammered with, and the more complicated your tax situation becomes. So when you are a very high income earning individual and you've bought a couple rental properties, you've maxed out TFSAs, maybe you've maxed out your RSPs, or you have a corporation with a bunch of retained earnings, how do you shelter the future growth of that money from tax? All right. So taxation is a huge aspect of it all. And you're going to have a huge problem with tax, and it's going to permeate through your financial plan overall. Okay. One of the other things that you're going to be looking at, another problem you're going to have once you've amassed quite a bit of money, is investment volatility. All right. So if you are in, high growth type of asset classes, there's always a trade-off. Right? You cannot get high growth in this world from an asset class without some sort of volatility or risk. So this volatility and risk, we can manage it with insurance to a certain extent. Right?
Got it.
Then there's estate transfer. Transferring your estate to someone else is not always a smooth endeavor. And there are times when a portion of your estate needs to be transferred very quickly and very liquid to the next generation, which brings us to the next point, liquidity, right? You need liquidity, but a lot, and you'd be surprised, a lot of very wealthy families have zero liquidity.
Sure. Everything's tied up in assets that aren't liquid, so they might have net worth, but to access it's difficult. And is it really what they think it is on the market when they go to present whatever assets they have?
Exactly. So they have zero liquidity.
Yeah.
Right. And
you need the liquidity kind of instantly, I guess, when you're managing an estate.
Oftentimes you do, right?
To pay some of the taxes.
Oftentimes you do.
So, yeah.
And then the final portion is legal concerns. whether it's legal liability or family law concerns, right?
Family law would be people arguing over the estate?
No, that would be estate. That would be litigation against an estate. But family law in the sense of intergenerational transfers of wealth. So if you transfer things to, let's say, Aiden, right? And then Aiden goes out and gets married and then integrates in that family property, and you lose half of your gift, right? So a whole life policy specific, but not just a whole life policy. You can use universal life policies. They're just not my favorite to use. They're a little bit difficult to explain to people, but a whole life policy can be an effective tool to a certain extent for some people in solving many of these problems, sometimes all of these problems in one shot, right? Now, it's not a panacea that is going to solve all your
And is that why you're saying that you don't like it? Because sometimes it's presented as the one-stop solution to all of this stuff? Or what is it that you don't like about it? Locked into this fixed term where you have these payments every year for this thing?
What I don't like is when a salesperson will ignore the downsides of any type of investment.
And what are the downsides of that policy?
Well, a downside of a whole life policy is if you pull out early, you definitely can lose money. Number two, you're committing to a future cash outflow that you don't necessarily know you're going to be able to meet. Okay. Number three, sometimes it's very difficult. The concepts are very difficult to understand. It's very technical. If I show you, I have a book that I buy the new update every year, and it's called The Taxation of Life Insurance in Canada. And it's about yay thick. And it provides a really good primer on the basics of Canadian.
I'm only laughing because, listen, when we bought our policies, Nick and I, and credit to the he's a great guy and so patient with us, but I was throwing everything at him. Like, I don't need this thing. And inflation adjusted, what is this money going to be worth anyway? Like, it's ridiculous. And then, all these projections on reinvesting the dividends. And then you have to, like you said on one of your points just now, you have to make this annual payment. So are you going to be able to make this annual payment for like 20 years or whatever you're committing to your future outlays that you were talking about? That's something you got to think about, especially if you're doing something that's of some, that might be scary when you look at it.
Right.
So all these things, and then to understand the tax implications of like how insurance is handled, it's like the whole thing.
It's complicated.
It's like the most beautiful industry because I just figure out nobody understands what's going on and somebody's selling something somewhere and everybody talks about it.
Yeah.
Everybody kind of buys it. But
you never credit really where credit is due. The policies that you guys have are valid and sound. Like they're proper. They were properly done.
Yeah, I feel like
so I don't think you. Yeah. I don't think you were sold.
No, I don't feel that either. And I think after like the fifth meeting, we had like dug into the details of it. Yes,
I think it's very similar to what I would have done.
Yeah, got it.
Had you approached me for it.
You're being kind now. You're being kind.
And once again, at the risk of breaching confidentiality, because you did show them to me, but ultimately, though, you are in the correct thing, and it isn't for someone like you. It is definitely a worthwhile thing to have on the side, not as your main source of assets.
Got it.
Now, there are clients of mine who, I've presented a plan to them and they're like, I love it. Let's double it. And the reason being is they tried other asset classes and they can't stomach volatility.
Yeah, got it.
Okay.
Yeah, so it makes sense.
And for whatever reason, I always encourage my clients to invest in real estate directly, not through REITs, directly. They couldn't handle being a landlord.
And why do you advise directly?
Why pay the fees?
Got it. So it's just more efficient to invest directly.
I
thought it was going to be possibly because I like owning assets in my name directly. When I own things, we were talking about this the other day, like if I own a stock through my trading accounts, like I don't really feel like I own the Disney or Apple stock because if something was to happen, I know I'm going to get paid out in Canadian dollars. Like I'm not actually going to get mailed the shares where I custody those certificates or whatever they're called myself. It's like I can get price exposure to some of this stuff, but if there's a banking system crisis, which we don't have to go into because I know I just threw a curveball into this conversation, but if there was, I know that I'm not getting the assets that I think I'm going to get. I'm going to be cashed out in some dollar way. So I like owning things that I have my name on directly. That might just be old school, but that's part of the reason I like real estate. And then it's just like, I have the name, that's the property. I have direct ownership of this thing.
Well, I like real estate for a number of those reasons. Number one, I also like diversification, right? I like to have some real estate, some stocks, some life insurance, small business, right? I like to diversify. I don't want to put all my eggs into one basket, right? But I do really, really like real estate for a couple of different reasons. One, it's one of those things that you have to have. Not you as an investor, but you have to live somewhere. Your business has to be somewhere physically. And, unless, I don't know what religion I mean, you're probably Catholic, but, God ain't making any more real estate here. So it's a limited commodity, right? In terms of land.
Yes, it has some scarcity.
In terms of land, right? So I like to scoop up real estate. I encourage my clients to scoop up real estate if they have the stomach for being landlords, if they have the stomach for making these large purchases. It's scary to you and I, it's not scary. We've done it a million times, but to other people, it's scary.
Yeah. I now feel I can be plopped down in any city and just close my eyes and touch a wall and say, hey, what are the prices? What's the vacancy rate? And like, all right, let's go.
And just figure it out. Yeah. Right. And especially if you are okay with leverage and understanding the risks of leverage, rising interest rates, so on and so forth, which I am. I'm comfortable with it. I have X amount of properties and the interest rates skyrocketed and I still don't even know what my payments are because I don't care because I didn't over leverage myself, right? So if you're good with leverage, you're growth minded and you don't mind once in a while dealing with people and finite problems, real estate is an excellent asset class. And, I kind of pride myself on being able to play a supporting role in that, in real estate investors, either from doing written financial plans, placing them into insurance policies, looking after their side pocket assets, RSPs, things like that. I don't directly work in real estate, but indirectly I do.
Mm-hmm. Yeah, I think that's what we've always appreciated about you. You're rare in that regard. Most people are just going to talk about what they sell, right? And you've always kind of presented just, here is some things to think about, and I can give you my opinion on all of them. And that's rare, especially, I think in all industries, but definitely rare in insurance and estate planning and that kind of stuff. So it's cool that you're like that. But I got you off track there. You said real estate, the insurance policy, and some people double it because they don't have the stomach for risk, like what they might perceive real estate is. Real estate's another thing that you recommend. Were there other things? It was the insurance policy, real estate.
I like large cap stocks.
Okay.
To me, well-established companies, to me are something that is within the fiber of our society, right? Like a well-established tech company, a well-established utility, a well-established bank. I think that they are something that provides long-term value, and the proof is in the market. Like well-established companies that oftentimes well-established companies that pay dividends, at least in Canada, you've gotten decent returns for literally doing nothing, like literally doing nothing. Now, obviously, when you take a look at it in terms of the money supply and this, that, and the other, you can argue it in many different ways, but buying stocks of large cap, well-established, well-capitalized, profitable companies takes no effort. You don't have to do anything. So you can't be rewarded to the same extent that you would be rewarded by actually doing something, running a small business or buying a piece of real estate, putting a tenant in, doing a little bit of work. You get what I'm saying?
Yeah, I totally do. Do you think, do people that you've seen who've acquired any wealth create it out of buying stocks, or is that like a diversification play? I've only really come across people who've made some net worth out of themselves coming from very little, who have started their own business or been involved in real estate. I've never really met the person who said, yeah, I made all my wealth investing in stocks.
I have one client who has never invested in anything other than ETFs, and he's not even 40 yet. And I think his portfolio was like $6.5 million.
ETFs would be definitely the way to go.
Right. ETFs in a couple of individual stocks that he likes.
But what about on a percentage basis? That seems like an outlier case.
No, well, on a percentage basis, okay, so this is an N of one. So it's not like a statistically representative sample here. What I'm trying to say is the formula is pretty straightforward if you don't want to lever up and go into real estate or buy into, ground up tech companies or, some sort of new technology where you're really taking a risk in volatility. If you want to go the route of tried and true traditional, less volatile assets such as whole life insurance policies, blue chip stocks, so on and so forth, you really have to watch the basic formula of building wealth, right? You make X amount, you spend X amount, you invest the difference. So it's really an exercise in increasing your revenue, decreasing and watching and being disciplined with your expenditures, and being disciplined.
Never doing well in that environment.
Right. So
some people are magic at it though, for sure.
And having the patience, right?
Yeah.
You're not going to make fast money doing it the traditional route. Can you build wealth? 150% you can. You need a decade plus of time, and you have to be very disciplined in your spending. Okay. So I do have a number.
Yeah, that's
of
fair. I guess if there's people my age now at 51 who've been doing it, hardcore, disciplined for 20 years and done index funds where maybe fees haven't eaten them alive. Yeah.
You could do it. Obviously, if you are going to buy a piece of rental property and pay it off, you're obviously likely, more than likely going to do better. Right. But, most of my clients who are, $5 to $25 million of net worth have a nice blend of stocks, life insurance, and real estate, with real estate being the heaviest component of even if you eliminate their primary residence,
sure,
real estate being a heavy component of their net worth.
That's one of the reasons I kind of went into real estate or stayed in it, is just because everyone I was meeting when I was younger, when I figured out what they owned, there was always this like large real estate component. Even if they were doing something else on their 9 to 5 or owned their own business, there was always this like real estate component. And I thought, oh my gosh, why don't I just go into that world?
100%.
So that makes sense to me. Okay, so what are some of the other problems that you cover in the book?
Well, those were the major problems.
Okay.
And it's always a combination of these problems, right? And in the book, at the one of the final chapters, I give sort of simplified real world examples of how the product can be placed into a financial plan to solve some of these problems, right? And if we have time, one of the examples, and I actually brought notes on this because
can you go through it? Can you go through it? And I want to ask you, before you go through that, on the very first problem you said people are going to hit would be on taxes,
right?
What's the example on that just at the time of the estate needs to close down,
right?
There's just not enough. Yeah. They don't have the proper wills in place to, what is the problem there?
Okay. So
I understand the problem is taxes.
Yeah.
Overall, that's the problem. But what specifically is happening that you made that the first thing?
So other than probate, which is not a significant tax, or
that's where the government's going to add up everything that you have
and take, let's say in Ontario, 1.5% of that. Okay, in order to administer the estate at the court level. Okay, other than probate, which there's a lot of probate planning that we can do with multiple wills and such, which is way beyond the scope of what we're going to talk about today. Other than probate, there's income tax, which June 25th is going to become an even bigger problem because of the increase in the capital gains inclusion rate. All right. So income tax in Canada at the estate level, there's no direct income tax. Like some other countries have a direct estate or inheritance tax. We don't really have that. What we have is an indirect tax. So you'll hear the words or the term deemed disposition many, many, many times in the Income Tax Act and in when you speak to accountants and lawyers. A deemed disposition is essentially, let's pretend you sold all your stuff at fair market value to yourself and then reacquired it, or to your estate and then reacquired it. When you die, it is the final chance, or when you leave Canada, it's the final chance for the government of Canada to tax you. All right. And they have a policy of not allowing the ultra wealthy to continuously pass assets down to the next generation over and over and over again without taking some sort of share of those assets. Okay. It sounds crappy when it's happening to you, but from a societal standpoint, this is necessary. Otherwise, you're going to get these ultra wealthy families that are never going to pay tax. Okay. So when you die, you have a list of assets that you purchased at an adjusted cost base, $100, and then have increased in value to the day you die, $500. The spread between the 100 you paid for and the 500 that it's worth when you die is considered the gain, the capital gain. Today, that capital gain, half of it would get included as taxable capital gains on your final tax return, and you would owe tax on that. Next week, whatever the date is.
June 24th,
next week,
is it 24th?
25th, I believe.
25th, 2024, this changes.
Right. With this government, I don't know when things are going to change or if
none of us do.
I don't know anymore. But
flying by the seat of our pants.
Let's say next week, that inclusion rate in excess of $250,000 will be 2/3. It doesn't matter. Whatever it is.
Sure.
It doesn't matter. The point being is that when you pass assets to the next generation, you are going to owe some tax. Now, a horizontal passing of assets between yourself and your spouse does not attract tax. There's an automatic spousal rollover. So it's really the second death of a married couple that we're worried about, not the first death. It's the second death. So that is the big tax issue from the estate perspective. But on top of that, you're getting taxed the whole way up in terms of investment income, capital gains, interest, dividends, so on and so forth. Those are all taxed as they happen throughout your life. So what we do in the insurance industry is we repackage people's idle cash or repurpose some of their liquid taxable investments under an insurance policy. And within certain limits, as outlined in a very complex manner in the Income Tax Act, you can, quote unquote, invest the money, get a return on investment, reinvest it, and never have to pay tax. So conceivably, you can pop your money into a policy up to certain limits, grow that policy through policy dividends, and then pass it to the next generation in the form of a check or cash without ever having to pay tax.
Is one of the only ways you can do that?
There are a couple of ways, TFSAs.
Okay, yes.
But highly limited.
Okay.
Right? Everybody loves a TFSA until they realize what the limit is and what are you going to do with that, right? Life insurance, your principal residence, a small business.
The principal residence can be passed on to the next generation.
You elect the principal residence.
Yeah, okay, got it.
Exemption at death.
Yeah. Hadn't thought about it.
Some farming and fishing property.
Okay.
Right? And a small business up to certain limits, right?
Small business up to certain limits?
Yeah, let's say $1 million. Okay.
Okay.
Up to $1 million can be transferred because you can elect. You can claim the lifetime capital gains exemption.
Okay.
Okay. So there are a number of ways we can do that, but idle assets, just boring idle stocks or bonds or GICs, that kind of boring stuff that's super liquid that you can liquidate right away.
It's going to be taxed.
It's going to get taxed. So what we do instead is we pop it.
Wayne Gretzky rookie card. How about a Wayne Gretzky rookie card?
You know what?
Maybe it was in a shoebox somewhere, Fab.
And nobody knows about it. Just pop it into, go to Scotiabank downtown and get yourself one of those lock boxes.
Okay, got it. Yeah, but that stuff's going to be taxed. I got it. Right? Yeah.
So, one of the techniques that we utilize a lot, I utilize this a lot for people, is sort of an intergenerational wealth transfer of liquid assets, right? And there's multiple, I'm going to show you why I use it. It's not just about tax. It's also about other benefits as well. Okay. So you may hear of...
It's amazing how much you like this stuff. You really like it.
Well, if we cover another topic, I'll like the other topic instead.
No, it's good. It's good. Keep going.
So, sometimes you hear of it referred to as cascading insurance or a waterfall strategy. Yeah. Really, you can market it however you want. The idea is this. A parent or a grandparent can buy insurance. It has an insurable interest in their child or grandchild, right? So a parent, or let's start with a grandparent to show you how this works multi-generationally, right? So grandma and grandpa, they've got taxable portfolio of $500,000 that they're like, you know what, we're rich and we're keeping this $500,000 for little granddaughter. All right. And we want to transfer this over to them in the most tax efficient, private, cleanest way possible. And we don't want to incur just a crap ton of legal fees to settle a trust and accounting fees every year to file the trust return. And we don't want to go through any of that crap. But on the same token, we want to grow this money, and we also don't want to freaking pay tax on our own tax return every single year when we get dividends and interest, right? And we don't want to think about what to do with the money. We don't want an investment advisor calling us saying, hey, I want to buy Google today and I want to sell Nvidia, whatever. Yeah. So you get what I'm saying? Yeah. They're like, I just want a solution that's simple. Peace of mind, and I don't want to lose any money. Okay. So what we do is we implement something called a cascading life insurance strategy, or a waterfall, whatever you want to call it. So grandma, grandpa who legally have an insurable interest in their granddaughter will buy and own a life insurance policy on their little granddaughter. Doesn't matter how old she is. Okay. They will then fund that policy from that $500,000 over, let's say, a 10-year period, $50,000 a year, whatever it is, until that policy is paid up. They will make themselves the irrevocable beneficiaries, or maybe even their child, like the parents, parents, the irrevocable beneficiaries. And then they can make either the grandchild at the age of 18 or the parents the contingent owners of the policy. What that allows them to do is reroute what would otherwise be taxable investments into a non-taxable account. Build it up. Then they have the choice. Inter vivos, or during their lifetime, they can choose to gift the policy to their grandchild. Let's say when she turns 18, she can use the money, she can borrow against it, whatever it is that she wants to do, she can do. They can keep themselves as irrevocable beneficiaries, or maybe the parents as irrevocable beneficiaries, which allows them to control the asset, disallowing her from pulling it out to, invest in something stupid.
Got it. But if she did have control, she could access the cash. Let's say it'd been fully paid up and it had a cash value of
$1 million. Okay,
$1 million by the time she has access to it, because the investments had been reinvested or some time passed. It's $1 million. She could go and access that $1 million. She could do whatever. So it's a way they've transferred that $500,000 tax free. She's not taxed when she access that money, because really what's happening behind the scenes is she's borrowing from the policy. The policy is the collateral that the bank's using to give her
she borrows against it.
If she borrows against it. But that would be the way. I'm just trying to map out. They had $500,000 cash, and this is a way to get the granddaughter the $1 million, the $500,000, but invested, so it became $1 million, let's say,
whatever
many years later. And that's how she could extract it and get the cash. And in that process, the granddaughter has not paid any tax.
Nobody's paid
And the grandparents have not paid tax. Was it a tax deduction when they made the contributions?
No.
It wasn't a tax deduction.
After tax dollars.
So it's after tax dollars, but they weren't taxed on any of the gains on the life insurance policy. So they were no further taxed. Granddaughter gets the money.
Right. And I believe it's section.
It's a pretty nice way to get. And have you worked with people who take these policies to the bank and the bank actually lends against them?
All the time.
Okay. Is that a special call to the bank? Like, I don't feel like you're walking into the branch and saying.
No. There's special departments that do that. We utilize Duca a lot. They're super smooth.
So this is what
it's
they do.
It's not a plug for Duca. It's just that
I get it.
They happen to be super smooth.
Okay.
And it's really
so this is done. I guess I only know actually one person who's done this. So
we do this all the time.
All the time. Okay.
Yeah, all the time. So the idea here is you've taken what would otherwise be taxable investment assets that are earmarked for the child or the grandchild, and then you have tax sheltered those assets legally during your lifetime. You can pass it down to the parents, who can then cascade it down to the grandchild, and then the death benefit will go to the great grandchild tax free. So you've literally taken 4 generations and avoided tax completely legally. Like completely legal.
It has to be. My mind just goes to inflation adjusted. What are the dollars worth? But if you're the insurance policy, I guess, projects out what they're investing in, what their returns are going to be.
Right.
On all those formulas, I feel like I saw so many pages of projected. Like, I don't really know what the insurance companies are investing in. But
well, it's pretty simple. It's
like a basket.
Yeah,
I know it's public, but when I look into it, Fab, I'm always, I'm a very simple person. When I see all these pie charts and all these things, I just think like, I don't know what's happening. It looks
let me ask you a question. What do you think that they're investing in?
It's been a few years since I've looked at it, but I feel like it was a basket of real estate, a smaller amount of equities, some debt stuff, some bonds. Like it was a diversified portfolio of the biggest asset classes that exist.
It's an institutional asset.
Yeah, that's what
right. So it's meant to sort of grow consistently, not very quickly, right? So you're going to get equity exposure. You're going to get private lending, mortgages.
Yeah, REITs.
Not REITs. Sometimes
direct ownership.
Actual direct ownership of real estate.
Yeah.
So there's it's quite a diversified pool of assets. And the reason that they do this is the actuaries need to time the risk profile of the portfolio of investors. They have to time out when people are going to die, so on and so forth, right?
So where do people, that sounds good what you're describing. I can't believe I just said that. I guess for some people it sounds good. I'm clarifying.
Some people.
Where do people make mistakes? I guess it's just case by case, because I was going to answer my own question saying some people buy too much, but then for other people, like you said, don't trust themselves or don't have the stomach for volatility. They're like, this is good for me. Where do people go wrong with this stuff? You know how there's high cash value type policies, right? And so, is there like just a rule of thumb that you're like, a lot of people tend to make this mistake? Okay. Or is it just too unique that you can't even answer that question?
No. I do see common.
Okay, yeah. What are those?
Okay, so the most common error is people will, let's say somebody has a really good year. A realtor, for example.
Oh, geez, they overcommit.
Oh, and obviously the person who sells them the policy is smelling the commission, so they're ready to sell them the fucking policy, right? Sorry for my French, but
no, yeah, got it. It's a serious discussion, yeah.
So
we've seen people do that, by the way.
Yeah, and it's a mistake that can happen, and I'm not going to. It's happened to some of my clients where they're like, hey, listen, I'm going to do this. Yeah. I'm like, are you sure? And then, they run into trouble here and there. We have methods to like help out. And it's not just cut and dry. Oh, can't make the payment.
Sure. And after a few years, you can have some of the dividends that wouldn't offset some of your annual
policy
fee.
Holiday or whatever it is. You can borrow against the policy to pay whatever, right? But the idea is the primary thing you need to do, in my opinion, when you are looking at one of these particular policies, it's okay, how much liquid assets do I have right now? Is it realistic to believe that I'm going to continue to earn the type of money that I'm earning? So let's say you're a doctor or a dentist or some sort of a professional where you're kind of almost recession proof. Sure. Yeah. But if you're in sales and you had $1 million year in real estate, and then
why do you keep picking on real estate?
Well, because it's
I'm joking. Yeah. I'm joking. No, it's the right category to pick on.
Yeah, exactly. It's like, some realtors did really, really well. And then
for the last 15 years,
they did shit. Yes. Right. And they blew all their money and I love realtors. I have a lot of realtor clients, super successful, like multiple 7-figure per year realtors, but they love spending money.
Yeah.
They love
true. It's so true.
So it's one is not predicting cash flows correctly. That's the number one. Okay.
Fair.
Number two is overestimating or underestimating the need for insurance. Okay. So buying too much insurance.
Not being realistic.
Okay. Well, buying too much insurance in the sense that, it's very easy for me to calculate, hey, you're going to have this tax payable when you die from your 10 properties. But the reality is your kids don't want any of those properties.
Yeah.
So who cares about the tax you're going to pay? Because they're going to sell that shit anyway.
Sell them. If there's some equity there, it'll pay for the tax
or under purchasing insurance.
So there's not enough to sell.
There's not enough to cover the issues that you have, that you will inevitably have. Okay. So under purchasing. So you got to be able to purchase the correct amount.
Yeah.
Other problems that I'm seeing is that the temporary insurance needs are not being addressed oftentimes when people buy a permanent policy. I'm going to give you an example. All right. I had a couple that come to me. This was many, many years ago. And they bought, they had a bunch of idle cash sitting in their corporation. They wanted a whole life policy. So we slapped on a whole life policy, and, the team did what's known as a needs analysis. And we're like, listen, you're kind of like underinsured from a temporary perspective, right? In the sense that, okay, listen, they both work on their business, but it was the dad who was the primary breadwinner in the sense that the business would be nothing if he wasn't there, right? Mom played a huge role in the business, but he did all the sales. And if they weren't bringing in clients, it was project based. If they weren't bringing in clients and they didn't have his expertise, they were screwed. All right. And they didn't really have, I can't remember if they didn't have enough term coverage, but it was going to expire shortly. So we said, okay, look, we can sell you the coverage, the permanent coverage. We can, overfund it and build up a beautiful cash surrender value, yada, 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 all that crap. Right. But I would be a little bit more comfortable if dad bought this cheap rider at least for the next 10 years. Okay. And we said, all right, at the very least, I want to be able to cover this policy up until it's projected to offset, which would have been, in their particular case, because of the way that the policy was structured, after 5 payments, you can offset the policy and you wouldn't have to pay it anymore because they did maximum funding. So we did a little analysis. We said, okay, look, let's take double of 5 payments and slap it on as a term rider. Turns out a couple years later, this guy got diagnosed with cancer. And he's alive and well. This was like...
But that rider, that term policy covered that situation?
If he died, that rider would come into play because it was a joint last to die policy. It was an estate-centric policy.
But the rider wasn't.
The rider was just on his
Got it. Wow.
Okay.
Yeah.
So thank God we didn't have to...
horrible conversations. That
they're horrible. But
you need to plan.
Right?
Yeah.
So thank God we didn't... He's in remission. Yeah. So he's good.
But I'm sure they felt great having that rider.
Man, if we had to pull the trigger, then that would have been life-saving for them, right? Because they wouldn't have had to cash out. They wouldn't have had to cash out the policy, and they would have had some extra money on the side. Right.
Just hearing you describe this kind of stuff, how we are changing that capital gains in this tax in this country, and we're moving it up a little bit. It's basically affecting everyone.
It is
because from a state planning point of view, well, because I think it's being sold to the population that it's really just like the quote unquote wealthy or this tiny percentage. But really, on a state planning point of view, this is something that everyone needs to be aware of.
Well, yeah. I mean, listen, if you own a couple rental properties, I technically suppose you are wealthy, right? And if you hold them until your death, like that's a lot. That's a lot of assets. That's your primary residence plus 2 rental properties. You're wealthy. Like,
so you're going to get
you're not the typical. And I have nothing against any political party, but you're not the typical person who's going to vote for the NDP. Right. So the government, and I'm commenting on political policy here, which I'm not an expert on, but the government has to balance the need for revenue and the need to take care of people that are literally, they're not necessarily lazy if they're going paycheck to paycheck. It's just, this is their situation with taking from people that are really doing well. And, once again, it's up to people to make their own political decisions and vote for whomever it is that they want, right? But that's what they're trying to do with these new policies and the new inclusion rating. Keep in mind,
you're such a nice person, Fabio. No, but you're just a good guy.
Look to history.
The way you're describing that so nicely, you're just a nice person. Yeah, good for you.
Listen, I'm politically
no, it's coming across really even.
I hate all political parties.
Yeah, they're all pretty useless.
I hate them equally. Yeah. Okay. They
agreed. Agreed.
I'm not sitting here saying, the conservatives are my favorite. I'm a card carrying conservative for the rest of my life. I'm not, and God bless you if you are. I could care less. Right.
I tell everyone all the time, I just want to know the rules of the game so I can navigate through them.
And that's
best
what my
of
job
my ability.
My job is to know the rules,
and you're really good at that. Yeah.
Navigate. Right.
I got you off track on your example. Did we cover the example?
Well, we can get back to that. But like in terms of the capital gains, for example.
Now I got you going. This is great. Okay. You go, Fab.
Look to history, right? Do a little Google search. the capital gains inclusion rate has fluctuated over time.
I know it has.
Right?
Canada's is moving up, and it's it's funny. I guess it's just an age thing, and I haven't known as many people as I know now who have some properties and have some businesses. But this move in the capital gains by this government, and doesn't matter which government it is, this government's making the move. I've never seen more Canadians respond so aggressively to me. And again, maybe it's just my age that I now know people of some means that are saying, that's it. I will not start up another part of my company here. I won't be hiring more people here. I won't be expanding here. I won't be buying another property here. I am going somewhere else. How do I get into the US? How do I go elsewhere? And maybe it's all just people emotionally reacting and it kind of dies down a little bit. But as far as my adult life, I've never seen a reaction quite like this. This to me, I don't know if it was the straw that broke the camel's back. I've never seen so much pushback on anything. This is the most I've ever seen in my adult life. And again, I don't have complete context of the world. I don't know everybody in the country of Canada. I just mean from the people around me that I'm hearing from, this one touched a nerve.
Well, maybe you're lucky. Because if the people around you, it's touching a nerve, that means you're hanging out with some privileged, wealthy people.
Well, I wouldn't.
Right?
I wouldn't say it that way. I would say maybe I'm hanging around with some productive people who've produced enough value in the economy, and I don't know if you want to chase productive people or irritate productive people away from what they're doing, because ultimately they're creating stuff that's taxed. And if you don't have this group of the population paying tax, then what do you have?
Well, yeah, I agree with you in that sense. But what the point I'm trying to make is this isn't a new thing. Right.
Sure.
It's you're hearing about it now. Yeah. You're hearing about it now because you're 45 to 65 years old, productive, making good money with an asset base.
And that's fair. And I can
when
totally
we were
accept that.
20 years old, we weren't paying attention to this shit. We wanted to go out and
it was
party.
A deep recession in the 90s. Nobody could even work. Yeah. You couldn't even pay tax because you couldn't earn money.
We didn't care.
No. Can I get to the club?
Yeah. Can I get to the club?
Do I have some? Do I have like extra $2, $2.50 for the street meet at the end of the night?
Exactly. So now you care about it. But trust me, there were people back then. And if you look to history, fair. Right? Just in Ontario, right? The brain drain. Remember the brain drain?
Yeah.
Right? Where,
what was that era? Late 90s?
I would say somewhere in the 90s where they're like, hey, we're losing doctors, engineers.
You are a nice person, Fab. Very balanced. So look at you. Yes. I remember the brain drain.
You got to think about that. And yes, definitely. In the introductory chapters in my book, I briefly touch on the realities of taxation in Canada. And I'm like, hey, listen, number one, there's nothing wrong with wanting to be wealthy. Mm-hmm. It's not a bad thing, in my opinion. No. This is all opinion based, but in my opinion, it's not a bad thing to want to be wealthy. It's not a bad thing to want to provide for your family.
There might be bad ways to get wealthy.
100%. Right? There's bad ways to do a lot of things, right? But it's not a bad thing to want to build personal wealth and to provide for your family. Mm-hmm. Okay. But it is, you have to look at the data, and I think it's like the top 20% of income earners in Canada are pretty much footing the entire tax bill. And that's just income tax. I don't.
Not only, I was going to say it's income tax. That's to me, almost the sad part, that it's employee income tax. The corporate tax contribution in this country, the last time I looked at this data, it's literally a fraction of that. I think that it's
corporate tax is not nowhere near it doesn't have as big of a dent as personal income tax, right? However, if you think about it from a policy perspective, that does encourage corporations to reinvest their assets. Yeah, sure.
And in defense of this country, I will say that I don't know what the current tax rate is for net income under $500,000, like the first $500,000 of net income. I feel
in corporations?
Yeah, in corporations.
In Ontario, it'll be about 12.2%.
12.2. Okay, I thought it was 12.5, 12.2. Yeah. So actually, that's fantastic, because to me, that's encouraging small businesses to get off the ground, because you have a multi-million-dollar business, your net income might be, I don't know what margins you're going to be, but yeah, if you were $2 million gross revenues and you had 500,000 net income, you got a great margin there, and you're being taxed at 12.5. It's encouraging you. That's actually really encouraging. So I will give Canada credit for that.
It is encouraging, right? When you follow the Trudeau government's sort of tax policies and specifically concentrate on small businesses, they haven't really played with the small business deduction. It's the actual tax rate.
And I really appreciate that. Yes.
And it's very competitive worldwide. And then
I think that's better than the US.
It is. That's why they use LLCs a lot in the US, because they're like, well, I'm not going to pay fucking tax at the C Corp level. Okay. I'm just going to disperse it to the LLC partners or members and let them pay personal tax, because their personal tax rates are lower than ours.
Oh, got it. Right? And through an LLC, they can do that in the US. Why do you know this? You cover US taxes as well?
Slightly. I only know enough to cause damage.
Okay. Right? Cool. That sounded really good. Yeah. That sounded like rocket science to me. I was buying what you were selling. Oh, great. They use LLCs.
Yeah. No, I know enough about US tax to know when there's an issue and send them to a US CPA. Yeah. Right. Yeah, got it. But the idea here is that the government has policies you incorporate a business, reinvest in that business so that you can create more Canadian jobs, and then give you the incentive to sell that business tax-free down the road. It's one of the few tax incentives, life insurance, primary residence, farming, and small business, where you get that lifelong tax incentive. Right?
So you can use that tax incentive for selling a small business one time. Is that how that works?
You get up to a certain limit. Don't quote me on the limit. It's like $1 million or whatever, but you get a certain limit for your entire lifetime.
That if you were to sell a business, that $1 million would be tax-free.
Yes.
The first $1 million if you sold a multi-million-dollar price.
Yes, correct. Okay. Correct. Right. So what they did do, though, is they closed the very well exploited loopholes that existed, that everybody knew about for a long time.
I don't think I knew about them.
Well, for example, like Newman shares.
Okay.
Right? Newman versus the Queen. Many decades ago, this guy, Newman, paid his spouse this ridiculously high dividend on these shares of the private corporation that they were ridiculous.
Okay, so they were distributing through dividends.
And they were income splitting like crazy and saving all kinds of money. And it went all the way to the Supreme Court, and the Supreme Court was basically like, hey, listen, we understand what you're trying to argue, the Queen, right? But you need to rewrite the legislation because we have to follow the law, right? So what happened was, for decades, we would have.
So it was a legitimate thing.
It's legitimate. We would put everybody, like mom, your grandma, grandpa, children, wife, dog, cat, everybody was a shareholder with these special shares that had no power to control the company.
So it was a legitimate loophole.
Legitimate.
There was some charity. Wasn't there like a weird charity one a while ago too?
Well, those weren't loopholes. That was tax fraud, in my opinion.
Oh, really? Yeah. So you know what I'm talking about? I don't know the details. I know enough to be dangerous when I say the comment. Okay.
So there was that loophole. Then there was the other kind of, let's call it a kind of loophole, where you could build up in your private corporation, and you could utilize a trust to purify your corporate retained earnings out of your corporation, which we still utilize the structure. Give the dividend up to a trust, give the money from the trust to a side company, like a holding company, and have like 10, 20, 30 million dollars of investable assets in this side company, and still have a purified corporation and pay the small business deduction and everything. So they shut that down. So
what do you mean purified?
Well, your company has to be purified. You can't have like a personal portfolio of stocks and real estate.
Oh, got it. Okay, so the money that was moved off to this other side corporation or whatever.
You got it.
So, and they were investing it over there.
Right, and that was a legitimate strategy that we utilized and still utilize to a certain degree to save for small business owners, to save for their retirement. Well, the Trudeau government came in and said, listen, as soon as you hit $50,000 of investment income in your associated group of companies, we're going to start grinding down the small business deduction and increase your tax rate up to the general rate. And if you exceed, I think it's $150,000 in any given year of investment income within your associated corporate group, next year you lose your small business deduction completely.
Got it.
Bumps your tax rate up from 12% to 25, 26%, whatever it is, right? Depending on your province, right? So they closed that loophole as well. So a lot of the policies that this government is implementing, they're kind of closing these, let's call them loopholes, that we in the tax community were freely utilizing. Even like last year, we were doing the surplus strips, right? Converting what would otherwise be a taxable dividend into a capital gain. That was rampant, right? But does this all have unintended consequences? Is it going to drive innovators and small business owners away? Is it going to discourage them from innovating and running small businesses? Because when you look at the data, small to medium-sized enterprises in Canada are a huge factor in the economy. Huge factor.
I would think that we're now, and it could be just a narrative thing, that the way this last move has been presented by the government, I feel like there's been a mental shift where people in Canada are like, enough.
It's possible. It is possible.
And again, I understand your context. Like, I'm just of that age and have friends who've run businesses. So it's tough to know if it's any different than 20 years ago. And just, during the 90s, like we're talking about, difficult to know. Yeah, I guess
time will tell.
Yeah, that's it.
Time will tell. I'm not a politician. I'm never going to be a politician. I would rather live on the street than be a politician. But I'm also definitely not an expert in, economics or social science or anything like that. I just kind of, like I said, the only thing I'm qualified to truly talk about is, okay, take the rules that affect my clients and how can I navigate those rules legally in their best interest. That's it.
Yeah. Did you want to get to something here that we had, or we covered
we kind of covered the concept. It's just one example of how that you will see in the book in much more detail.
Okay. I had a question for you. Are you going to have to get your US knowledge up a little bit?
Correct.
Not just because I can tell from the people I'm speaking to, and now you're of the age that you're going to have some friends coming to you saying, hey, we're going to do this in the US. They might not be leaving Canada, but they're going to operate a little bit in the US, or they're going to buy a property in the US, whatever they're going to do. So it's going to be to your advantage to know that. So, and knowing you, because you like to get in the weeds, that's going to come into your repertoire here. You're going to further develop your US knowledge.
150%. So I am planning this summer to fly down to state of Florida, Fort Lauderdale and Miami area. And my cousin, Vito La Balestra, great guy. He's a realtor and small business owner in Southern Florida.
Vito's got to be one of the best Italian names.
Oh man, it's
Vito
actually John Vito.
That's the proper name for Vito?
No, his name is John Vito.
John Vito.
Yeah.
Vito's just amazing.
Man, that's number one.
My next door neighbor was Vito.
That's a classic
Vito
name.
is so good.
Right?
Yeah.
Classic name.
So anyway, you're going to see him.
I'm going to go see him.
So just to understand the inner workings of how...
Right. And I have his, he's active on social media. He's active on YouTube and whatnot. And I literally just started a YouTube channel not too long ago.
Awesome. What's the YouTube channel?
It's literally the Campanella Group.
Okay.
Nothing fancy.
Got it.
Right. And I put together my first few videos, and giving it my best shot, So, here's my shameless plug. Just subscribe.
It's great. Yeah.
Anyways, I'm going to be using his camera crew, and we're going to sit down with a US CPA, a US attorney, him, and we're hoping to get in a US finance expert that is an expert in obtaining financing for non-Americans. And we're going to kind of do a panel, like a podcast, but with specific questions and specific technical things that I want to cover with them. And like I said, you guys sent me some questions that you guys had, or we're
going to bug you to do that for Rockstar members. Like, as soon as you're back, we're booking you for an in-house thing 100%, like that. Yeah.
So I'm hoping to.
So any Rockstar members listening out there, we're going to get you that information
for sure. I'm hoping to put together like a good quality hour and a half long video that's going to be to the point, informative, so that at least people that do want to expand into the United States, either from a business perspective or from a real estate perspective, are at least going to know where to start this journey, right? Like,
just so you have a bit of a roadmap.
Exactly, right? There's way too much information to know all the details, but it's like, hey, listen, you're going over there, you're going to need a lawyer for this, you're going to need a mortgage guy for that, and you're going to need a US CPA for this, and this is the freaking deadline, right? Because the IRS doesn't mess around.
Yeah, I was just listening to some tax lawyer explain from the US at some filings that I think you were alluding to when we talked the other day that have to happen. Otherwise, you get like a $10,000 fine. It's just for like a piece of paperwork. I think that goes to FinCEN or something like that over there.
It's like you mail it in or something.
Yeah, and if you miss it, you get this fine. So I just want to repeat for any Rockstar members who are listening to this, Fabio, we are definitely going to get him to share that information. We have a bunch of that already on the Rockstar member site for members from one of the accountants who I think we got introduced because
I'm
he's a friend of yours.
Yeah.
So thank you for that. So we're just going to enhance that, and we'll be.
And he's the CPA I'm going to interview.
Yeah, awesome.
Yeah.
Awesome.
Yeah. He's a great guy. And the example that I gave you here in this podcast, I actually have it in way more detail up on my blog, on my website, campanellagroup.com. So
Cool.
if people are interested in that, because I know I taught the life insurance and estate planning course for you guys yesterday, and awesome. A lot of people were interested in this particular strategy. So I said, you know what, I'm going to put something together for them.
And that was the example of using a policy to pass on money
generation over generation.
Got it. Yeah. In my head, I'm just going to label this passing on money tax-free.
Pretty much. That's what it is. Right?
Yeah. Yeah, Fab, I appreciate you doing this. What else, anything else that you wanted to share today that we haven't covered?
No, I kind of wanted to limit it to this narrow area, tell people about the book that I'm hoping is going to be edited and out by the end of the summer. And then I guess also the US stuff that I'm really looking forward to that. That's going to be challenging, but I'm really looking forward to improving my knowledge on US tax and setting up US business structures.
So needed. I think you're hitting a sweet spot at the right time for this stuff, Fab. And I just want to repeat for anyone listening who hasn't heard you before, honestly, what we appreciate about you so much is that you present information very evenly, like I was describing earlier in this podcast, like an unbiased approach, like, here, think about this and this, or you haven't thought about that. And it might not even serve you. It doesn't align to your incentives on how you're getting paid and making money. And we totally appreciate that about you. Thanks for teaching the class to Rockstar members. I didn't even know the class was last night. Thank you for doing that. I mean, we're really, really grateful to have crossed paths like this the way we have. It's hard. We know a bunch of people in the space, and we like a bunch of people in the space, but we find very few who can marry estate planning and insurance and understand real estate, and then have other contacts, legal contacts, where you can kind of get it all done. You're kind of turning into what is the definition of a family office?
Well, yeah, I guess that's what it's evolving into.
It seems
my
like
practice.
That to me, right?
It's a family office, right? It's it's like, okay, you come to us. We're going to quarterback your investments, your estate plan, your financial plan, your legals, like your accounting, your tax. And it's not necessarily me doing all of that, but it's people that I'm working with every single day. My estate lawyer, I talk to him all the time, him and her. It's a team. My corporate lawyers, I'm talking to them all the time. The family law specialists, so on and so forth. Right. So it's evolved into that where, I don't even know how to, sometimes I have trouble. I call over my wife. I'm like, how do I open this freaking shit? I don't even know how to open the software anymore. Right. Because it's just, I'm thinking from
you're quarterbacking all of this. Who is your ideal client walking into your office right now? Somebody looking to set up some estate planning and has a bit. So someone who has maybe a couple properties or running a small business and then beyond.
I guess, listen, I'll talk to anyone, because even if I don't take them on, I know somebody who's hungry for that type of client. Okay. And who's going to service them well.
So you take on new client calls still. They book. They go to your website and get booked into your calendar. Yeah, you just
book it, and then I'll send them a calendar link, and I'll give anybody a half hour. Right. Okay. But who I'm actually taking on, it's really people that they're not fully necessarily, they don't have to be fully established, but they are financially established, and they're at the point where okay, I've outgrown the basic accounting and the basic, financial advisor at the bank who's just putting me into the bank's products.
They want something a bit more strategic.
Something a bit more integrated, something a bit more strategic, and they want to tap into my network. That's the big thing. They want to tap into my network.
Which is the value.
Right?
Yes. Yeah, agreed. Awesome, Fab. Thank you. So tax-free, which is the best website? Is it taxfreeinvesting.ca?
Taxfreeinvesting.ca is sort of the holding page for the book. The book? If you just, it's very simple. If you give me your email, I'll let you know when the book is ready. The ebook is free. It's going to be, I'm just giving it out. Okay. So if you are interested in the book and knowing when it's coming out, taxfreeinvesting.ca. If you're interested in reading about the strategy today, just go to my blog. It's on my regular website, campanellagroup.com.
Okay.
And that's where you can get in touch with me, whatever. And then, if you watch YouTube,
Subscribe to the channel. We know the Campanella group. Subscribe to we are starting a new channel. Actually, let me ask that too. If you're listening to this, the Your Life, Your Term show, we're breaking off to its own YouTube channel.
No.
And it's called the Your Life, Your Term show. Big surprise. We have gone now, I think the Rockstar Real Estate channel has 10 or 11,000 subscribers. Now we're starting from scratch again. So if you're listening to the show, we need to build it up.
Yeah.
So far, it's like, let's build our dog, myself, Nick.
I mean, I got nobody. I got
four of us.
600 or 700 subscribers. I got nothing.
You're ahead of us on the new channel. I think we're literally.
I've got like maybe 5 or 6 videos, right? But
no, it's good content.
It's a lot. It's a lot of work, but you know what? It's worth it because once again, I'm putting it out to the public, so I better be right.
Yeah.
You know,
Fab, appreciate this, man. Thank you so much.
And thank you for having me, brother.
Hey, thanks for tuning in. You can find every new episode of the Your Life, Your Term show on all the major streaming platforms. So Spotify, iTunes, Google Play. And if you'd like to get free copies of some of the books that we've put together, like these right here, or some of the reports that we've put together, like these right here, you can find all of those at www.rockstarinnercircle.com. That's www.rockstarinnercircle.com. That's it for now. Until next time, your life, your terms.